So yesterday we talked about money and just briefly talked about banks. Hopefully, you're able to complete the new used activity where you look at the website and after you do that, type 2 or 3 sentences of why a vehicle may or may not be an investment. So let's look at the notes now and start with the First Bank of the United States. And yesterday we finished by talking about Alexander Hamilton wanting a central bank, and this is exactly what it would be, and it would be called the First Bank of the United States. And it would be given a 20-year charter in 1791. That was kind of a compromise. Thomas Jefferson, for instance, was leery of creating such an institution, so it was only given a 20-year charter. 1791. And it had great success in bringing order to the banking industry. But as the economy improved and things got better, when 1811 rolled around, people said, well, maybe we don't need it anymore. So the charter was left to expire. After the War of 1812, there was economic chaos, and so there were new calls for another central bank. War of 1812, after many wars, there's recessions, economic instability. So after War of 1812, there was chaos, and there were calls to develop a new central bank. And then we enter the Jacksonian era, and with the rise of populism and the idea that a common man can, of course, be more involved, and Andrew Jackson was a symbol of that. But the Second Bank of the United States will be created. And it will literally be called that, the Second Bank of the United States. And it is also given a 20-year charter in 1816. It too is successful, but when its charter came up for renewal, Jackson decided to veto it. He believed that the bank was too friendly to the rich, which is true. Rich people have more money, so of course they're going to be more successful with banks. But he decided to veto its rechartering. So then we enter what is known as the free banking era. And there are four major problems that happen during this period of time. One would be bank runs. Bank runs. People hear a rumor, may not even be true, that the bank is closing. So they run and pull out their money. Well, banks loan out most of the cash they have to collect interest and make a profit. So they don't even have enough money to cover everybody if they come to pull their money out. So the first 10 out of 1,000 people in town pull out their money, maybe 15 and 20. And once you get up so far, they've run out of cash. So then the bank goes belly up and everybody else loses all their money. So bank runs were common.
I actually first learned what a bank run was when I was 8 because I watched Mary Poppins.
Oh, yeah, Mary Poppins, It's a Wonderful Life. There's a few different movies that feature that. Wildcat banks were another problem. They were established on the frontier and were incredibly unreliable. New towns springing up and then folding later on, like Pitt City, for instance. If they did have banks, they were not reliable. The third problem would be fraud. Fraud. Obviously, with little oversight, it was easy for bank owners, bank employees, and other people to commit acts of fraud. I mean, back then, people were excited about getting a bank, so you could just rent out a storefront, paint bank on a sign out front, and then collect people's money throughout the day and just ride out of town, never to return again. So fraud was incredibly common. And then the fourth issue was currency. Without a central bank and a national currency, people were making all kinds of it. States, cities, businesses, banks, churches. Lots of institutions were making currency, making a confusing, inefficient system. And then there's the Civil War and Reconstruction period. The North attempted some stability during this time. They did establish a national currency known as the greenback because of the green ink it was printed with. It also passed the National Banking Acts of 64 and 65. National Banking Acts. It's to give the government the power to charter banks and require banks to hold gold and silver to back the paper notes that were issued. So chartering banks and requiring those banks to hold gold and silver to back the paper notes. The South, in the meantime, as the picture at the bottom illustrates, backed their money with cotton, which was an incredibly stupid idea, just like the Confederacy. So, of course, as we blockaded the South, the price of Southern cotton dropped drastically, and their money, which many Southerners invested in, became worthless. So take that, traders. But the government relied heavily on the gold standard, linking a definite value of the dollar. The theory is that the government will only issue currency if it has gold to back it. There are, of course, different problems with that because the government can all of a sudden say, well, maybe this gold is worth something different, and so we can print more money. And the price of gold, of course, fluctuates heavily. And I guess there's also a third problem. There's not enough gold to back everyone's dollars throughout the world. And then we enter the progressive era where there's still lots of bank chaos. Bank failures every year, people losing their money. And then the panic of 1907 happens, where there is a wave of bank runs throughout the United States. (1907). That's when shortly afterwards, with the next few years, we decide to establish the Federal Reserve System. This would be our third central bank. So the first one was called the First Bank of the United States. The second one was called the Second Bank of the United States. and the third one is called the Federal Reserve System. But there's a reason why it would be called that, because it's not exactly the same as the first two. It is a type of central bank, but its member banks are part of the private sector. So there isn't necessarily just a chain of federal banks across the United States. What really makes it up are these private sector member banks. There is a Federal Reserve Board, which is appointed by the president and approved by the Senate. Of course, the most important person on that would be their chair. One of the most important functions of the Fed is to loan money in the short term to prevent bank failures. Loan money in the short term to prevent bank failures. It also regulates banks and conducts monetary policy, which means it controls the money supply. Unfortunately, it also wasn't really, I don't want to say it wasn't given a lot of power, but at the time, the general thinking was if something bad happens, you really don't need to take any action. And then, of course, the Great Depression happened. And the Fed not taking action helped make the situation worse. Banks were loaning large sums of money to businesses that were expanding. They were also loaning money to people that were buying stock in the market, which is a bad idea. It's like loaning money to a gambler. And so the Fed wasn't paying close enough attention to what banks were doing. The Fed also didn't act quickly enough to increase the money supply. Increasing the money supply might have helped stop the Great Depression from getting worse. So after the Great Depression, the Federal Reserve started playing a more active role in trying to cushion recessions. They can't necessarily prevent one from happening, but they can try to cushion the effect. FDR also established a series of bank holidays, days in which banks would be closed to prevent people from panicking and pulling out their money. So bank holidays. And another thing that would be done is the Federal Deposit Insurance Corporation would be started. Federal Deposit Insurance Corporation. And the Federal Deposit Insurance Corporation, or FDIC, is insurance on your checking and savings accounts. So if your bank does go belly up, they're covered up to a certain threshold, $200-some thousand or so. But the problem was, of course, with all these regulations, some thought that there were too many. So when Ronald Reagan got elected in 1980, he proposed decreasing regulation, particularly over savings and loans, a type of financial institution. So Ronald Reagan proposed decreasing banking regulations. This resulted in a number of institutions failing, causing a recession in the early 90s. Banks were also allowed to participate in more financial sector activity, like investing. And by the 90s, bank mergers became more and more popular, with banks becoming bigger and bigger while swallowing up other ones. This will all set a perfect storm for 2008. More and more profit motivated, banks will start lending wildly in the early 2000s, particularly in the housing market. Not only will they be lending wildly, but they'll take those mortgages and bundle them and sell them to another company. So bundled mortgages will be sold to other companies. Just in case something goes wrong in the economy, those companies will also carry insurance on those bundled mortgages. And then what always happens? After so many years, the economy cools. People lose their jobs. They can't pay their mortgages. They default. And it grows and grows and grows until there's too many bad mortgages in that bundle that was purchased. And so you end up having these finance companies go belly up. And there's not enough insurance money to cover it. So then insurance companies also end up failing. And it spreads and spreads and spreads. And there are still some banks that hold on to these mortgages, so they go under as well, or at least face financial difficulty. So the entire financial sector was endangered because of overlending, particularly when it comes to housing. And that's what caused the Great Recession in 2008. And the last thing that I'll mention is, as a result of this, the Dodd-Frank Act was passed, which was spelled D-O-D-D, and a dash, and then the name Frank. The Dodd-Frank Act tried to restrict dangerous banking activity. Overlending for housing, overlending to younger people at college campuses. They used to just come and hand out credit card applications. They're not allowed to do that anymore. So it greatly restrained some of those banking activities. Of course, some banks complain about that because they can't make as much money.
I remember Mr. Wayne telling us, like, he took a summer trip.
Mm-hmm.
There were people who were passing out beers for anyone who would sign, like, a credit card thing.
Yes. Yes, it used to be quite common. When I was an undergrad, there'd be booze in front of the student union building. People just handing out credit card applications. It was ridiculous because they want to make the interest off people. They want people to run up debts and make huge amounts of interest. So, for the remainder of the period, don't forget to complete the rent or own. It's similar to the new used activity where you look at the website and then explain why or why not the owning a property is like an investment. For the remainder of the period, of course, you can work on the quarter 4 assignment, the portfolio for the finance, your future job, and what your beginning salary is, and how that would work out for a monthly budget.